you're 10 years out, we've left $5 trillion of potential growth on the table. That's the output gap or the growth gap, the difference between depressed growth and trend growth. That's how much wealth has been lost because of this depressed growth. But being objective, using the numbers I mentioned, we're in a depression. We're going to stay that way. The United States is Japan. Japan had the famous lost decade. Well, the lost decade was 20 years ago. It started in 1990 through 2000. Japan's now almost at the end of their third lost decade. If something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, well, the headwinds, demographic, technological, productivity, psychological, etc., haven't changed, and there's no reason to expect they'll change. So combine this world depression, because what I just described is true of Japan, it's true in Europe, not so true in China, but China's a special case. They cook the books. They're 7-8% growth that they've been printing. Cut that in half because 45% of that growth is infrastructure, most of which is wasted. So if you apply generally accepted accounting principles and made them write off all that wasted investment, they'd be a lot lower than it appears. But the whole world is caught in this trap. Meanwhile, debt is going up faster than the growth. Is debt good or bad? Well, it depends. Debt can be good if you can afford it, if you can pay it off, and you can use it for productive purposes. It's bad if you can't afford it, it's not sustainable, you're using it as a substitute for real growth, and it's all going to crash and burn. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I spent a lot of time looking at, the debt to GDP ratio is getting worse. It looks like we're heading for a global debt crisis. Not quite there yet, but it could happen sooner than later. Very little doubt that the Fed is going to tighten in September. My baseline scenario for the Fed is straightforward. They're going to tighten 4 times a year, every March, June, September, and December, 25 basis points each time until they get interest rates up to, 3.25%, 3.5%, somewhere in that range, unless one of 3 pause factors applies. The pause factors are disorderly decline in stock markets, employment starts to go down, they basically lose jobs, their unemployment's going up. The third one, disinflation or deflation spins out of control. Right now, none of those 3 pause factors applies. The stock markets, they're going sideways, but they're not crashing. The Fed doesn't care if the stock market goes down 15% in 6 months. Do care if it goes down 15% in 6 days. That's disorderly, and that's the kind of thing where you would see the Fed pause, but that's not happening. Job growth is strong. Inflation is ticking up. I don't think it'll spin out of control, but we're out of that disinflation danger zone. So none of the 3 pause factors applies. Therefore, you should expect the Fed to just keep raising. But there's no doubt that the Fed is over-tightening because in addition to trying to get interest rates back to normal, they're also reducing the balance sheet. They're trying to normalize the balance sheet. But now the Fed has a dilemma, which is what are they going to do if the U.S. economy goes into a recession? As I said, we're in the 10th year of an expansion. The old cliche, expansions don't die of old age is true, but they do die. And history shows that it takes about 4 percentage points of cuts, 400 basis points, in other words, for the Fed to get the economy out of a recession. Well, how do you cut interest rates 4% if you're only at 2%? The answer is you can't. You cut them to 0 and then you're stuck. You're at that zero bound, and the evidence is good that negative rates don't work. So then what do? We're going to print some money again, and I think the Fed disagrees, as shown by their own actions in trying to reduce the balance sheet. So what the funny mode? One thing I never do, I never make a forecast or make a claim without backing it up. There are people out there that are a dime a dozen, this is going to crash or this is going to go up or growth is great or it's so whatever. That's fine, but you need to back that up with some kind of analytics, some kind of data, some kind of analysis that you can do. And I always do that. I'm always happy to kind of drill down on that. So the methodology I use is quite different from what Wall Street forecasters use. First of all, I'll just spend a minute on what Wall Street does and what most analysts do because it's badly flawed. It's no surprise that, every year the Fed does a 1-year forward forecast. So in 2009, they predict 2010, 2010, they predict 2011, so on. Same thing for the IMF, same thing for Wall Street. They are off by orders of magnitude year after year. I mean, how can you be wrong by a lot, 8 years in a row, and then have any credibility? And again, the same thing with Wall Street. You see these charts. The chart will show the actual path of interest rates or the actual path of growth. And then the timeline, which is the x-axis, they'll show what people were predicting at times. The predictions are always way off the actual path. And there's actually good social science research that shows that economists do worse than trained monkeys in terms of forecasting. And I don't say that in a disparaging way. Here's the science. A monkey knows nothing, right? So if you have a binary outcome, up, down, high, low, growth, recession, and you ask a monkey, they're going to be right half the time and wrong half the time because they don't know what they're doing. So you're going to get a random outcome. Economists are actually wrong more than half the time for two reasons. One, their models are flawed. Number two, what's called herding or group behavior. An economist would rather be wrong in the pack than go out on a limb and maybe be right, but if it turns out you're not right, you're exposed. There are institutional constraints. People want to protect their jobs. They're worried about other things than getting it right. So the forecasting market is pretty bad. The reasons for that, they use equilibrium models. Capital markets are not an equilibrium system, so forget your equilibrium model. They use the efficient market hypothesis, which is all the information's out there. You can't beat the market. Markets are not efficient. We know that. They use stress tests, which are flawed because they're based on the past, but we're always outside the past. The future could be extremely different. If the next crisis is worse, there's nothing in that history that's going to tell you how bad it can get. And so they assume prices move continuously and smoothly, so price can go from here to here or from here to here. But as a trader, you can get out anywhere in between. And that's where all these portfolio insurance models and stop losses come from. That's not how markets behave. They go like this. They just gap up. They don't hit those in-between points where they gap down. You're way underwater or you missed a profit opportunity before you even knew it. So in other words, the actual behavior of markets is completely at odds with all the models that they use. So it's no surprise the forecasting is wrong. So we talked earlier about business cycles versus depressions, and that's conventional economics. That's really thinking in terms of growth, trend growth, below trend growth, business cycles, etc. Collapse or financial panic is something different. A financial panic is not the same as a recession or a turn in the business cycle. So let's talk about financial panics as a separate category. Complexity theory shows that the worst thing that can happen in a system is an exponential function of scale. Scale is just how big is it? Now you have to talk about your scaling metrics. We're talking about the gross notional value of derivatives. We're talking about average daily volume on the stock market. We're talking about debt. We could be talking about all of those things. This is new science, so I think it would be years of empirics to make this more precise. But the theory is good, and you can apply it in a sort of rough and ready way. In other words, if you triple the system, the growth went up by a factor of 10, 50, etc. There's some exponential function associated with that. So, people think, well, gee, in 2008, we learned our lesson. We got debt under control. We got derivatives under control. No, debt is much higher. Debt to GDP ratios are much worse. Total notional value, gross notional value of derivatives is much higher. Now, people look at the BIS statistics and say, well, banks actually, gross notional value of derivatives has been going down, which it has, but that's misleading because they're taking a lot of that, moving it over to clearinghouses. So it's never been on the balance sheet. It's always been off balance sheet. But even if you use the footnotes, that number has gone down for banks, but that's only because they're putting it over to clearinghouses. Who's guaranteeing the clearinghouse? Notice the risk hasn't gone away. It's just been moved around. There's more concentration. That's another risk factor. Taking that all into account, you can say that the next crisis will be exponentially worse than the last one. That's an objective statement based on complexity theory. So you either have to believe that we're never going to have a crisis, and I'm like, well, you had one in 1987, you had one in 1994, you had one in 1998, you had the dot-com crash in 2000, mortgage crash in 2007, Lehman in 2008. Don't tell me these things don't happen. They happen every 5, 6, 7 years. Doesn't mean it happens tomorrow, but nobody should be surprised if it does. So the point is, this crisis is coming because they always come, and it'll be exponentially worse because of the scaling metrics I mentioned. Who's ready for that? Notice the problem has never gone away. We just get bigger bailouts at a higher level. What's bigger than the central banks? Who can bail out the central banks? There's only one institution, one balance sheet in the world that can do that, which is the IMF. The IMF actually prints their own money. The SDR, the special drawing right. SDR is not the strawberry daiquiri on the rocks. It's the special drawing right. It's world money. That's the easiest way to think about it. They do have a printing press. And so that will be the only source of liquidity in the next crisis because the central banks, if they don't normalize before the crisis, and it looks like that they won't be able to, they're going to run out of money and can't expand the balance sheet beyond a small amount because they'll destroy confidence.